Fiskarma agus Falcha, and good afternoon and welcome to the University of the Highlands and Islands. For those that don't know me, my name is Gary I. Campbell. I am the Key Account Director here at UHI, and we're delighted to welcome you all along today. Thank you very much for coming. The background to these series is that we like to engage with the wider community. My job is employer engagement and also and essentially community engagement as well. University of the Highlands and Islands covers an area that goes from, if you take it on the map, from the southernmost tip of Greenland right the way down to the northernmost tip of the south of the Republic of Ireland. We fit nicely in that gap. So it's a vast area and we've got all sorts of different cultures within that. Plan today is we've got a fantastic guest. We've got Carl Paraskevas. He is a senior economist with Lloyds Banking Group and works specifically in this part of the world with the Bank of Scotland. And we're delighted to have him here today because we're going to talk about how global economic trends actually affect us here in the Highlands and Islands and what sort of things we should be looking out for. First of all, Carl, welcome to the Highlands and Islands.
Thank you very much.
You know, given what you do and the job you do, and you see the international perspective, and given the fact that we're just out of probably the worst recession in living memory, certainly since the 1930s, as an what's keeping you awake at night as an economist?
Well, you're absolutely right, Gary. Clearly, we've come out of, if not the deepest, but the prolongest recession in recordable history. We're certainly on the road for improvement. So if we take a look at the recent economic data out there, it suggests that the UK economy will probably grow around 3% this year. The US is well on its way to recovery as well. The last couple of quarters have shown some really great signs of growth. And that lays the backdrop that things are great. I guess perhaps they're too great than monetary policy makers believed 6 or 7 months ago, where we would be, particularly the drastic fall in unemployment on both sides of the Atlantic between the UK and the US. So my number one real concern is monetary policy error. Number one, monetary policy makers got it wrong last year of how good things actually would be. And I think if we look from 2008 and the amount of monetary stimulus, both in the form of quantitative easing but low rates, by the end of the Fed's QE program, we're looking at potentially the Fed printing over $6 trillion worth of US dollars on asset purchases. And it took quite a long time for them to debate whether to withdraw that, and it's taken them a year to slowly wind down their QE program. So the next movement really, and my key risk is interest rate and tightening of monetary policy amongst developed banks. That would rank number one, because that has the potential to dislodge both financial markets but the real economy globally. I think number two, probably the second biggest concern, is obviously the well-publicized slowdown in euro area growth and depressed inflation in those economies. We struggle with the periphery being very weak given the financing issues we've seen in Europe, but certainly it looks like now that the core could also be coming under strain. And I think for us here, and particularly in the UK, that's going to have potentially negative implications looking forward over the next 2 years. I think the third bit is probably the one player we haven't talked about. We talked about the UK, the US, we talked about Europe. Obviously China sticks out in the sense that we've had some fantastic growth levels from China over the last decade. There's clear evidence that China as an economy is slowing down. Some of it being positive, of their own wishes to reform away from a manufacturing, largely export-dominated economy towards a domestic consuming, services-oriented economy, taking it to the next step in growth on a much more stable pattern. But in the short term, those reforms and the undertakings that are happening there certainly present some significant risks to the global economy, particularly with the recent data that we've seen that leaves the trajectory for growth moving into next year somewhat suspect. I think probably the final two that really weigh on me, one is the geopolitical risks we've seen in the Middle East that continue to carry on, but also the geopolitical risks closer to home in Europe with Russia and the situation in the Ukraine. And the follow-on to that is obviously as the developed economies show improvement, particularly the US and the UK, emerging markets as a whole have shown more sluggish growth over the last year. And the financial market implications of developed world raising rates does have negative implications for emerging markets.
I'll tell you, I'm glad I'm not you because you must be awake all night. If you're staying awake at night because of geopolitical things, I think probably I would be retiring, but that would be me.
Well, it used to be my son. I mean, my son's sleeping in his own bed now, so that's
Now you
that's
can go.
kind of improved some things. That was my personal biggest concern.
But within that, I mean, you talked there. I mean, there's so many things I think in each of these points that you made. You know, we've got an issue in Russia. It's close by to us. We've got an issue in the European Union where it just hasn't taken off. We've still got issues, you know, in Greece and Portugal that are really well known. And then, you know, but all of a sudden, Britain and America seem to be doing that a little bit better than we expected. I mean, where does that leave the United Kingdom? You know, and I suppose things like maybe the UKIP vote, you know, that's maybe going to raise its head next year. I mean, where does that leave the UK sitting within all these outside influences?
Well, I certainly think I'm not a politician, so I'd lay off UK politics. But what I would certainly say is that, you know, when we look at the UK economy and its recovery, it's been fairly unbalanced. So we look at the growth that we talked about, these great numbers so far this year. They've largely been driven by domestic factors. So a pickup in household consumption in particular, so retail sales have been pretty well held. Number two is a pickup in investment, and we're not really certain the pickup in investment we've seen is really a sea change in the investment atmosphere of new investment, or the fact since the crisis, actually we've underinvested and we're just replacing existing capital as it depreciates. So I think those are for domestically, for me, the unbalanced nature where we're not getting a pickup in exports, some to do with Europe, certainly is one of the things that I would highlight as being a concern. And how we interact with Europe in the future is also going to be quite key, since it's our largest trading partner, our sole trading partner. It's about 50% of our tradable good exports. So we can't really devolve away from the European question too suddenly. And we've got other streams of things that are going on at home that are quite important. We've got energy policy, which is becoming much more crucial. We've had the drop in the crude oil price this year. We had about a 10 to 11% drop since the start of the year. At its peak, we've had a 30% drop. You know, last time I checked, we were at around $81 a barrel now, so certainly not going up in the short term. And I think that poses challenges both here regionally as well as we look at the UK as a whole in terms of what that means for investment around the oil and gas sector. But it also talks about energy security when we talk about Ukraine and we start dragging in the larger picture of how we're going to be energy secure and potentially less reliant on both Europe but also the United States and other trading partners in terms of our energy needs. And I think that needs to be well grounded out. So I think we're looking at Europe and we're looking at the whole piece of the puzzle having to come through, and the decision makers in the election will have some significant impact on that.
I know it must be pretty difficult, I suppose, for the guys in the Monetary Policy Committee at the moment to actually make decisions, you know, given the fact that they've probably got things a little bit wrong over the last little while, haven't they?
Well, certainly if things have improved so drastically in such a short period of time, then you start wondering, and you know, as I said before, we've had this massive amount of stimulus. And we're talking unprecedented historical levels of stimulus. Withdrawing that stimulus when things are better and knowing the right time to do it is very key, because there's not much upside. We get it right and we just carry along as we do. We get it wrong and we could have some serious volatile, not only financial markets, but your own real life impacts, both business-wise and household-wise. You know, if we suddenly have to raise rates sharply in a couple of years and we don't address some of the issues that we have now in terms of our uncertainty about the inflation outlook, about the growth outlook, and about having these levels of stimulus, then certainly that could be very disruptive for your everyday lives and businesses, as well as, you know, the global economy. So that's why it's so critical, and it is a hard decision. We're still putting, as a bank, the timing of our rate hike in Q1. It looks like from the latest information that we got from the central bank today about their outlook for inflation and growth, that we might be revising some of that outlook. You know, the risks are certainly that we push that into more summertime next year. Otherwise, none of our forecasts about U.S. interest rates, again, which we expect to be hiked in September, none of those forecasts have a drastic rise in interest rates in the short term. So we're talking, you know, 50, you know, half a percentage point, at least in the next year maximum. 75 basis points. Nothing drastic, particularly because the headwinds are so high. You know, we talk about, you know, some of the key boom has been household spending. Do you want to disrupt that? Do you want to disrupt investment patterns by increasing rates? And then the overarching thing about we talk about politics is obviously also our drive to clear our structural fiscal deficit. And a lot of that spending cuts actually haven't happened now. They're going to happen in the future. and whether you can have a high level of interest rates under that environment still remains very questionable.
And something you mentioned there, about you mentioned briefly about inflation, and then there's potentially deflation in the European Union area that we hear about. And also at the same time you talk about quantitative easing, and I think you actually said printing money, and trillions of dollars in the United States. Now, history has shown us that when you print money, or when any government or any economy prints money, that as sure as night follows day, inflation will come along at some point. But so far it hasn't. I mean, where's it hiding at the moment?
Well, I think you devolve it into two things. I'll give you the general economics spiel. But before we do that, I mean, you also have to remember that a lot of that plugging has to do with the fact that the type of crisis we came out of in 2008 was certainly geared towards the banking sector. I don't think anybody would deny that in the financial services sector. And that's sort of the key engine behind monetary and financial market mechanisms. So a lot of that was to also plug the sort of destruction of money at the same time that we were growing money. So that in part explains some of the reasons. Second of all, when we're looking at the timing of the hike, we're not looking at the short-term inflation rate. We're looking at more the medium-term outlook for inflation. That's the target that monetary policymakers look at. So while we had the crash in the oil price, we haven't really seen the wage growth we'd expect, although I'd say the latest employment and wage data has been a little bit more positive than we thought. There's really two keys that we need to see. We need to see either wages accelerate above our productivity level, which has been pushed pretty low at the moment. Productivity still remains relatively subdued in the UK. If we do see wages over the productivity level, that suggests that we are getting some of those domestic inflation pressures. So the central bank is likely to push and take a view of the whole holistic picture, just not the headline inflation number. Mm-hmm. Second of all, we had this drastic improvement in employment. We were talking levels of 8.5% unemployment, a year and a half ago. We're hovering around 6%. But the composition of that employment is still not super fantastic. If we had to chart it out, most of those gains in employment have been largely self-time and part-time work. Actually, we haven't fully recovered in terms of full-time employment. So the structure of it suggests that we aren't actually at our full capacity yet.
Does that mean that from an employment perspective, there are people who are effectively underemployed out there who could, so there's a bit of slack in the economy to grow even a little bit more?
That would certainly be the theory.
Mm-hmm. I like the way you say that, it's the theory.
Covering myself.
And then, obviously, Lloyds Banking Group represented in the north here by the Bank of Scotland in Scotland, and who were, as you can see, we're delighted to have organised this today. So with a Scottish perspective, obviously the oil industry is very important for Scotland, as is food and drink, as is tourism. How do all these particular pressures affect Scotland as a region of the United Kingdom or as a country in its own right?
I like to play on the positives, obviously. Let's start with the positives. I mean, I think number one, obviously, we're talking about emerging markets. We're talking about the problems we're seeing with China. Nonetheless, emerging market growth is going to outstrip developed growth. I think if we take a look at sort of the long-term figures, by 2030, 2040, it's not unforeseeable that the EM world will be just as large as the developed world. And that provides a huge market opportunity from an export perspective across a number of areas. Deep down in that, we've also got a rising middle class in a lot of economies. We talk about China's got a rising middle class. We've got India, Brazil. All of these places have rising incomes that are going to be purchasing more. And I couldn't think of one thing more people would want than whiskey and some of the great, shortbread stuff you guys do out here. So I'm thinking that that's a huge market and a huge potential if you get that right. And I think Scotland has already got some of the right relationships in those terms. They've been ahead of the curve. In some ways relative to the rest of the UK. I think number two, we talk about oil and gas, but we're talking about this whole energy structure of renewables. We've got renewables and a carbon target here in the UK. That's putting us in the lead to bring down some of the fossil fuel production in terms of energy that we've had. That puts us in a unique position to be able to benefit from that, particularly from the new electricity market reform. And that's not only skills that can be used here, but potentially skills that can be replicated across the world. But crude oil is still going to be important. Natural gas is still going to be key. And the demand isn't going to shift like that. So even though we've seen a drastic drop in the crude oil price to 81 from circa above $110 a barrel, the need and what we see on the sort of the cost curve of producing oil and the levels that are being demanded suggests that in the medium term, while we might have blips in the oil price, and natural gas prices, that's certainly going to be demanded in the future. and not only demanded in Scotland but abroad. And again, we're looking at, how you can actually take that expertise from Scotland and start, exporting it, which you've already done to a certain extent. But the opportunities are only going to grow, especially offshore exploration, which can't think of a better place that's got knowledge around offshore exploration. But skills are going to be important. Education, as UHI is trying to be important, is making sure that you're placed in the future.
Yeah, I mean, and it's obviously it's one of UHI's key sectors is energy in general, both oil and gas and renewable energy, and we've got significant expertise in parts of renewable energy that we hope to capitalise on and also effectively sell around the world, because at the moment, we've got what is one of the biggest laboratories in the world in terms of renewable energy, whether it's subsea, top of the sea, or whether it's on land, and we've been working at it here, of course. Some of the folk in here will remember that the hydro developments in the 1950s, hydroelectric, were at the forefront of that and have been all the way through. So I think that, I mean, from our perspective here, it's been interesting to see how we match that off with a potentially declining fossil fuel economy as well. That'll be fun to watch, I suppose. And then, I mean, you've spent some time here in the north of Scotland, and I mean, we ourselves here have got another economy in the Highlands and Islands. What about ourselves? I mean, if you were here and you ran a business in the Highlands, what kind of things would you be looking out for, given your knowledge that you've said, that would specifically sort of affect us in this part of the world?
Well, I think we talked about this rising middle income in emerging markets. It's capturing some of, number one, tourism industry. Chinese tourists and emerging market tourists aren't necessarily American tourists, so they travel in a different way. It's making sure you maximize on that capacity to be able to actually target what their needs are. It's attuning to a new type of tourist than you might have had in the past, and making sure that that's catered for. I think that's quite important. I think here also you're talking about, you've got some great natural resources, even outside of the oil aspect. I think some of the guys, when I've been up here, are talking about wave technology and offshore wind and all of those things. I mean, I think you've got the right mix for it. But against that backdrop, you have to think about competitiveness, education, also availability of workforce, and making sure you're driving all of those things to meet that demand. I think that's kind of going to be your real key. If there was a challenge point, is you've got all the things in the places. It's actually trying to get the right things in the right place and making sure they're at the right time to drive that ahead. That's no secret anyway. I mean, that's a necessary.
Yeah. And I mean, this is something that you're clearly passionate about economics, and I think you explain it in a manner that most lay people would understand pretty well. I mean, other economists I've heard, I wouldn't understand a word they said, and unfortunately, most of them I think are in television. But how did you get into this? 'Cause I mean, some of this sounds quite frightening. So how did you get into this, and what keeps you there looking at this every single day?
I was a lonely child. No, I'm just kidding. No, I mean, actually, when I grew up, I had no idea what I wanted to do. In fact, I was a real pain to my mother and had all kinds of issues there when I was a child. But I eventually got into university, and I kind of had very little direction. I had a great professor that kind of gave me a lot of direction in terms of, he was an international economist, Korean guy, Dr. Kim, and I had a lot of trouble with math, believe it or not, in the early stages. The biggest challenge was I was a good writer, but had a lot of trouble with quantitative stuff, and he really broke that for me. And I don't think if he broke that for me at that point in time, I might have abandoned the whole thing. So there was a lot of Korean food over an old terminal with SAS, statistical programming, and he kind of gave me the spearhead. And then I've had some really good people in my life, in my professional career, not only at Lloyds, but previous places. I worked at Merrill Lynch and stuff like that, and the guys were, really great guys. In a really great collaborative environment that drove people forward. So mentoring was huge in getting me to do that, I would say. I think it was the people surrounding me that helped me to be able to do that. And I can't thank them enough. So Nick and Dr. Kim, wherever you are, thank you very much.
I mean, from our perspective here in UHI, it's great to hear that that a professor inspired you, and we hope that we do that with every single one of our students, and fair play to you for taking it on. What took you to Europe? I mean, it's clearly from the United States, but what took you here?
Well, I initially came over here for my master's degree. I didn't anticipate really staying, and then I met my wife, and I've got a son, and life takes you on different courses, and you end up staying in places you don't really expect to stay. So I'm originally from Queens, New York, so this is a lot different. But But yeah, no, that's just sort of life change. And I've loved it here. I've loved my time in the UK, and I love my time in Europe, particularly as a hub for, it got so much culture and history. And I'm sorry that I can't spend more time up here just to kind of take it all in. I need to actually come for tourism once rather than and just to relax.
I'm sure we can work out a whiskey tour for you.
Yeah,
at
I'm
some
sure you
point.
can.
We can do that.
I'm going with you, Gary.
It'll be a long trip. Is there one thing, as an economist, that you would say we should be looking out for? What one thing would be going forward? What do we look out for in the future?
Well, we kind of labeled out the 5 things that worry me. I think the key thing is to be cognizant of actually what's going on, because in this type of environment where we've seen, particularly over the last couple of weeks, a lot of financial market volatility in equities and bond markets, I think you really need to think that, what does that mean for me as a real person, and should I be watching? And I think the answer is yes, be cognizant, be alert. If you're doing strategic business decisions, even if you're somebody young and thinking about your career and everything else, this is still quite a volatile time of where we are. Things have improved, but there's certainly room and scope for a lot of risk. And I think you have to be conscious of balancing the opportunities with the risks and potentially thinking about risk more than you would a couple of years ago. My best analogy is when I was working as an economist sort of pre-crisis, you just sat and you watched the inflation number being stable and growth was relatively stable. And I'm not at that point yet that I feel comfortable that I can just sit there and kind of take a gear back. If indeed it's probably more intense now that things are looking slightly better.
Just managing that process.
Managing that process, yeah.
I'd just like to thank you so much, Carl, for coming along.
That's
Absolutely
really
brilliant.
Really good.